following on from that, the Morgan Stanley, yes, it's got some good quality companies. It does look to show from more of the east to west trend, and also it works in cohesion with the global brands funds. So performance of it, it's hold it in my portfolio. It's done 55.6 year to date. Obviously, it's not as much as the Bailey Gifford funds, what they've done with heavy weighting in Tesla, some seeing kind of 100% returns, but you wouldn't be too complaining over the year return. 5 years it's done 226%, so very good, and it seems to be a consistent fund and also has solid management in it. Number 3, we're going into more of the indexes now, so low cost. I prefer a lot of index funds because they do keep costs low, they do have that diversification, and it's a cheaper alternative to active funds, or getting a kind of going into shares, which can, for example, cost up. For example, if you were to buy Apple shares, Amazon shares, they cost a lot of money to get in just to buy one share, so it's hard to diversify. Number 3 is the Ishares Asia MSCI ex Japan. Why is this in? A bit of diversification, low cost, as we said. If we look at the holdings, AIA Group, Commonwealth Bank, BHP, Hong Kong Exchange, Westpac, National Australia Banking, Australia New Zealand Banking, Wesfarmers. As you see, it's got a lot of Australian contingency there, one that many portfolios miss out. Also, Australia is a strong, solid nation. Hasn't been in a recession until this year, for I think the last 26 years. And also it's got a good economy with that. And also with that as well, it's got a bit of Hong Kong and Singapore, also very strong, stringent companies within it as well, large cap. Some that many miss out, I believe, in when they're looking at large cap funds, especially active and portfolios for personnel, they do miss out on the kind of Australian contingency, and I think it's one to keep an eye out, or the Asia Pacific MSCI World Eye. It's one to keep an eye on. Number 4 is the FTSE 100. Now this is one of 2 controversial ones. The Vanguard FTSE 100, again low cost. I believe the P ratios are looking attractive in relation to the price. It's one of those that hasn't seen growth particularly too much during the pandemic or before, especially when you compare it to the S&P 500, although you can't make the true comparison because its makeup isn't the same. It's not tech heavy, it's more made up of defensive stocks and banking stocks, mining, financial, insurance, non kind of sexy stocks, as you would call it. But think, why would you invest with this, with a lot of the turmoil that's going in the UK? Well, one, it's mainly larger companies, so they get their revenue from outside of the UK. 2 is, again, it's just undervalued, and I think this year, with what we've seen with all the tech stocks and everything going higher valuation, it'll be the value stocks that have fruition within the medium term, hopefully. So the number 5 is the Ishares Seng Tech. Now this is a bizarre one and also a very controversial one. Why is it being selected, or why do I have it in my top 5? Again, going back to what I said in the Morgan Stanley funds, is that it shows the transition to the east, and I think this, more than any fund, kind of composes it in its holding. Again, it's low cost, it's an index fund, so the cost is kind of 0.25, and it has good quality companies, or big large cap companies, so this obviously diversifies the risk against the accounting that you get in China, also the bit of the government, although it's not immune, as we've seen with Alibaba.